Hello and welcome to Week in Markets. I'm joined here by Sam Elliot, investment analyst. Sam, if we think about markets over the week, we've seen a settling down of volatility both in equity markets and in bond markets, which is pleasing. And financial markets, or should I say equity markets, have still grinded a little bit higher if we look at European equities and Japanese equities over the weekend. Today, in time of filming, US equities are higher as well. I suppose, what would you say the key reason is why volatility is or has normalized?
Yeah, I think it's just markets becoming a bit less sensitive to the tariff news that we're seeing come through. We think about back to sort of the end of March into April, we had a 10% drawdown in global equities for the first 8 days of April. We then had Trump announce the 90-day pause on tariffs. We've seen markets since then, equity markets grind higher. So we're actually back to about where we were at the end of March. So all of that loss at the start of April has been recovered, slightly ahead of where we were at the end of March. I think the interesting bit is just to contrast that with what we're seeing within commodity markets. So if we look at the oil price, that's been grinding lower through the course of 2025, and that's really continued despite the strength that we've seen in equity markets. So equity investors are maybe looking through the near-term volatility, whereas commodity markets may be suggesting a little bit more concern there, although there is also supply dynamics within OPEC, so increased supply from some of those oil-producing nations as well.
So quite a lot for the market to digest, and as you say, we had that initial sharp sell-off as all the tariffs were announced. Then we had the 90-day tariff pause, and then we've had multiple tariff rollbacks, which has just helped to drive equity markets higher. But as you say, equities investors have been had a longer horizon in terms of where they think earnings will get to next year. Whereas if you look at commodity markets, they've been very much focused near term on the growth slowdown and also just the increase in supply coming from OPEC, the oil cartel. So interesting dynamics, but very much pleasing from an investment perspective to see equity markets bounce back and volatility to normalise, which is pleasing. I suppose just sticking on tariffs this week, we've had a couple of developments within AI and chips, and also developments closer to home here in the UK. What details can you give?
Yeah, sure. So within the US, the previous administration under Joe Biden, they had a framework in place for semiconductors being traded. That was due to take effect next week. The Trump administration has announced that they won't be enforcing that framework, and they'll be revising their own and drafting their own framework as well. The previous one was more global in nature, targeting everyone with a sweeping brush. This one will be more direct. It gives countries the opportunity to negotiate as well. But I think the critical point is really that the crackdown on China remains. So there's opportunities for other countries, but still a strict policy in place on Chinese tech. As you say, also news breaking on Thursday this week that there's to be a trade deal announced between the US and the UK as well. So we've seen talks ongoing this week focused on things like steel and cars, which has been the areas of the UK manufacturing sector which has been hardest hit by tariffs so far. A trade deal announced there.
So I suppose a positive that the UK is the first of potentially many trade deals to come through. US equities responding well to that initially. We've seen a bit of strength in the pound, and I suppose this is a real positive that agreements are put in place. I suppose thinking about the UK as well, a key event this week has been the Bank of England and their interest rate decision. What were the details?
Yeah, so the Bank of England cut interest rates by 25 basis points, as was expected. I think the interesting bit is just the detail of the voting within that. So there's 9 members of the committee. We had 5 members vote for that one interest rate cut. You had 2 members vote for 2 interest rate cuts, and then 2 members vote for no cut at all, so voting to keep interest rates unchanged. So a bit of division there within opinions on the committee. I think markets have really just taken that as a sign that interest rates aren't going to be cut in an orderly fashion. I think the Bank of England are just monitoring the situation. There's a lot of uncertainty around trade. You had quotes from the governor, Andrew Bailey, just saying that this can't be done on autopilot. And you've seen that reflected within some of the bond market moves as well. So expectations for another cut to come through in June next month have been revised down. You've also seen, as you mentioned, a bit of sterling strength there as well.
So Bank of England lowering interest rates from 4.5% down to 4.25%. Division within the members, how much to cut. I suppose, interestingly, that they revised down their inflation forecast for this year and next year, revised up their growth forecast, so slightly better inflation growth mix than initially thought, but being a little bit more cautious in terms of guiding the market on future interest rate cuts, given the uncertainty around tariffs, which will persist. So positive news on the whole, though, for the Bank of England and UK households. I suppose we also had the Federal Reserve announce interest rate decision on Wednesday night. What was the decision?
Yeah, so the Fed kept rates unchanged, as was expected.
Yep.
I think that really the comments that came out there was just around uncertainty around trade and tariffs, heightened risk of rising inflation, heightened risk of rising unemployment because of that. So really just on hold, monitoring the situation. Obviously only a third of the way through the 90-day pause on tariffs, so still a way to go before we get any sort of clarity on that. And they really feel that they can't cut rates within that period. So we've seen some divergence between global central banks. You've got Bank of England, as we mentioned, ECB in Europe, also China this week, cutting interest rates, whereas the Fed feel within the US they're not able to do so at the current time.
So the key difference for central banks around the world outside of the US is that they've got a much more benign inflation impulse compared to the US, because if you think for the US, the growth impulse is stronger, but also the impact from tariffs is far more severe. And also thinking about energy prices, which we talked about at the start, to take someone like the UK, a big importer of energy, and if oil prices are down, somewhere between 15 and 20% this year, that's a big positive for lower inflation. And as you said, UK interest, the pound also helping to bring down inflation. So just a real divergence between the two. The US very much being more patient, and I suppose can you touch on what their opinion is of the growth data? They talk more about the realised hard data and the survey data. How would you contrast the two?
Yeah, it's something we've been talking about as a team as well. We've seen a real difference between the soft data or survey data, as you mentioned, and also the hard data, which is more the actual realised economic data coming through. We've seen last week, we had the jobs report. It was really strong, lots of jobs added. That's really in contrast to what we're seeing within some of the surveys that have come out, particularly on the employment front as well. Survey data much more influenced by sentiment, mood within the economy, whereas the hard data are actually painting a picture of a pretty resilient US economy at the moment. So that impact of tariffs not yet being seen in the data.
And I suppose that speaks to what the Federal Reserve were talking about, is that the upside risks of inflation, of unemployment going higher have increased, but that's not yet coming through in the data. Jobs being added, and so are therefore being a bit more patient until we get into July, when the details around tariffs and how they'll be implemented will come through. So an interesting divergence, but importantly for investors, global equities have taken the decisions in their stride, volatility is coming down, and we're becoming more to a more balanced equilibrium. Thank you, Sam, and thank you all for watching. That's everything from us today, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.